Have you ever really stopped to think about what happens to your money after you deposit it? You know, it doesn't just sit in a little box with your name on it. Today, we're going to follow the secret journey of your dollar to pull back the curtain on how banks actually work. So let's start right there, payday. You've worked hard, that notification hits your phone, and you see the number in your banking app. But where is that money really? Is it in a vault? Is it digital? What is the bank doing with it like right now? That's the big mystery we're going to unravel. And to figure that out, our first stop on this journey is to understand what a bank's real job is. It's actually a lot simpler than it sounds. At its absolute core, a bank is just a money middleman. Seriously, think of it like a giant bridge. On one side of the bridge, you've got people, maybe like you, who have some extra money they want to keep safe and maybe grow a little. And on the other side, you have people who need money for big things, like buying a car or starting a company. The bank, it's the business that builds the bridge and connects those two groups. So it all boils down to two key players. First, you have the depositors, the savers. That's you when you put your paycheck in the bank. Then you have the borrowers, the people who need a loan. And here's the key idea that changes everything. When you deposit your money, you are technically lending it to the bank. And when someone else gets a car loan, they're borrowing from the bank. Okay, so let's bring this back to you. How does this all play out from your side of the counter? Well, your relationship with the bank usually starts with one of two kinds of accounts, and each one has a totally different job. On one hand, you've got your checking account. This is your workhorse, right? It's for your day-to-day life. Swiping your debit card, paying your bills, sending money on Venmo. It's all about easy access, which is why it usually pays you basically zero interest. But then, on the other hand, you have your savings account. This is where you park your money for the long haul, think emergency fund or saving up for a big trip. And because the bank knows you're not going to touch it as often, they actually pay you for keeping it there. That payment is called interest. So yeah, let's focus on that savings account because this is where you're not just storing your money, you're actually putting it to work. How? Through the kind of magic of interest. So what is interest? Well, it's just the price of using someone else's money. It's that simple. When you get a loan for a car, you pay interest to the bank. But here's the cool part. When you put money in a savings account, the roles are completely flipped. Now the bank is using your money, so it has to pay you interest. It's your reward for letting them use your cash. Let's make this super real. Imagine you put $1,000 into a savings account that pays 3% interest for the year. That's the APY. You just let it sit there, you don't touch it. At the end of 1 year, you'll look at your account and see your original $1,000 plus an extra $30. $30 the bank paid you just for keeping your money with them. Pretty sweet, right? But wait a second. If the bank is paying you $30 and paying millions of other people interest too, how on earth are they making any money? Well, this is where we go behind the scenes and see how the whole business really works. And this quote right here, it gets right to the point. Banks are businesses. They are for-profit companies. They are not just holding your money out of the goodness of their hearts. They're actively using your deposits to make a profit for themselves. So, how did they do it? Their main trick is something called the interest spread. Take a look at this chart. The bank might pay you, the saver, a pretty low interest rate, maybe 1% on your savings. But then it takes that same money and lends it out to a borrower at a much, much higher rate, like, say, 8% on a car loan. And that difference, that gap between the rate they charge and the rate they pay you, in this case 7%, that is the spread. That's the bank's golden goose. It's their core profit margin before they even pay their own bills. It is the absolute foundation of their entire business model. Okay, this all seems to make sense, but it leads to a really weird question. If your $1,000 is now part of someone else's car, how can you still go to the ATM and pull out your cash? Is your money actually there? The answer is kinda. And it's all thanks to a system called fractional reserve banking. Here's how it works. When you deposit your $1,000, the bank doesn't have to keep all of it. They're only required to keep a small fraction, a reserve, on hand. Let's say $100 for daily withdrawals. They then take the rest, that $900, and lend it out to a borrower. But here's the thing. Your bank app still says you have $1,000, even though most of it is now funding a loan somewhere else. And the craziest part? That $900 often gets deposited into another bank, where the whole process starts all over again. That is literally how new money gets created in our economy. Now, I know what you might be thinking. That whole system sounds a little sketchy, right? What happens if something goes wrong? Well, fortunately, there are some really powerful safety nets built in to protect you and your money. The big risk, the nightmare scenario for any bank, is something called a bank run. This is when there's a panic, and a huge number of customers all try to withdraw their money at the exact same time. And since the bank has loaned most of it out, it just doesn't have the cash on hand. It's rare, but it's the exact reason these safeguards were invented. And the single most important safeguard for you is deposit insurance. Here in the US, you've got the FDIC for banks and the NCUA for credit unions. It's basically a promise from the government that if your bank goes under, your money is safe up to a certain limit. And that limit is huge. We're talking $250,000. That's per person, per bank. So for almost everybody, this means your checking and savings accounts are incredibly safe, even if the bank itself gets into some serious trouble. Okay, so you've seen behind the curtain, you know the secrets. Let's bring this whole journey full circle. How can you take this knowledge and make the entire banking system work for you? First things first, you gotta know your options. Traditional big banks are everywhere, super convenient, but often come with higher fees. Credit unions are nonprofits owned by their members, so they usually have better rates and lower fees. And then there are online banks. They have no physical branches, so their costs are low, which means they often pass those savings on to you with the highest interest rates on savings accounts. There's no single best one. It's all about what fits your life. All right, here's your toolkit. A few quick, super actionable tips. Number 1, hunt for checking accounts with 0 monthly fees. They exist. 2, watch out for overdraft fees. They are crazy expensive, so ask your bank if you can just turn them off. 3, if you use a credit card, treat it like a debit card. Pay that balance off completely every single month to avoid those high interest charges. And finally, remember to shop around. You're not married to your bank. If you find a better deal, switch. I think this quote sums it all up perfectly. At the end of the day, banks are just tools. They're not good or bad. If you use them smartly, if you understand the rules of the game, they can be an amazing help in building the life you want. But if you're not paying attention, they can absolutely trap you with fees and debt. Being informed is your best defense. So I'll leave you with a little challenge. Now that you've seen the whole journey of your dollar, what's one small change you can make this month to use your bank better? Maybe you'll finally open that high-yield savings account, or maybe you'll just check your statement for hidden fees. Whatever it is, remember, your financial journey is in your hands. Thanks for joining me.